All right, welcome everyone. This is Scott here with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And I'm very excited about today's video because this is going to be my first recorded live trading session. And so now the plan for my channel going forward is every Friday's video is going to be live trading. And if you watch the video I posted, I think about 2 weeks ago, I'll post a card above linking to it so you can watch it if you haven't already, where I basically outlined my general approach to options trading and how that's going to be changing. Well, since that video, what I've been doing is I've been slowly winding down my current positions because now that I'm changing my approach in a somewhat significant way, I wanted to start with a clean slate. So right now I have no positions on, and I've also added some more capital to my account because this new approach is going to require a bit more capital. And so as you can see up here, as of right now, we have a total of $50,000 exactly of option buying power to play with. And so I'll be using this buying power to both be trading options and also stock. Right, what you're going to see in these videos is a hybrid approach of selling options and then also buying or shorting stock to hedge losing positions. And so with that being said, let's get into it here and start finding some new trades. And so what I have pulled up already is a 1-year price action chart of SPY. Right, this is one of the first things I check in the morning to see obviously where the market is at today. And as you can see right now, we are having a very small little down day. SPY is down by a whopping $2.60. But even potentially with this small down move, implied volatility may have spiked just a little bit. And yes, you can see that right now, the VIX futures prices are up about 2.7% right now. And in case you're wondering if you've never seen this before, the VIX index, or the VIX futures in this case, show you the implied volatility for the S&P 500. Which is essentially a measure of fear in the stock market. And as implied volatility expands, as it increases, that's going to increase the prices of option contracts across the board, not just for SPY, but for the majority of stocks as well. And so as I mentioned, as an option seller, that's my general approach, I want to be selling options when implied volatility is elevated. Now, of course, today it's not elevated by much, only 2.7%, but that's certainly better than nothing. Especially given that over the past few weeks, implied volatility has done nothing but just go straight down. And then as a result, the market has gone straight up. And so now that I've gotten some general awareness of where the market is at today, let's come over to the Market Watch tab and try to find some new positions. So what you're seeing here is my personal watch list of a variety of stocks and ETFs that I commonly trade. And right now I have them sorted by their IV percentile. Although it says IV percentile up here, there you go. They're actually sorted by IV rank. That is one of the few but very annoying bugs in the thinkorswim platform here. Whenever you see IV percentile, it's actually referring to IV rank. And in case you're not familiar with IV rank or IV percentile, they are simply just metrics that will show you how elevated implied volatility is for these various stocks and ETFs. So this number over here, this IV rank indicator, will range between 0 and 100. And the higher the value you see here, the more opportunity there is to be selling options. So that's why I had this list sorted by their IV ranks from greatest to least. So now I can just start from the top and work my way down this list. And one more thing to mention here, these small icons you see next to certain stocks, these represent events that are coming up, and specifically earnings events. And so if I can, I do like to avoid earnings in the expiration cycles of the options I'm selling. And so unless I am specifically selling options on an earnings announcement, basically minutes before those earnings figures come out, I do like to stay away from earnings announcements in the expiration cycles of the options I'm selling. So that's why initially here, I'm going to look at Marvel Technology. There's no earnings events coming up, and the IV rank for this stock is very high at the moment. It's over 50%. So let's go to the charts here and take a look at MRVL, Marvel. And there you go. You can see down here, both the IV rank and the IV percentile are very elevated at the moment. Now, one thing to note about those earnings announcement icons is they will only show up once those earnings announcements are within a few weeks from today's date. So just to double check here, I want to go to the Analyze tab and go to the Earnings. And then here I'll type in MRVL. And so now we can see Marvel has earnings on June 7th. So I'll just have to keep that in mind here. Let's come back to the charts. And so right now I can see that Marvel is rather range bound at the moment. So perhaps I could be interested in selling a strangle on this stock, which is the combination of both selling a call option and a put option at the same time. So let's come over to the trade tab now and take a look at the options on Marvel. And I do prefer to stay in the monthly cycles. So right now I'm considering either May or June. And given that May is expiring in only 21 days, my guess is if I go into these options here and look at their prices, yeah, they're not trading for very much. These are rather cheap options because they're expiring pretty soon. So in this case, I would be interested in potentially the June options, which expire in 49 days from today. And so now looking at these prices, I could be interested in selling the 50 strike call option and potentially also the 44 strike put option. This put option here has a delta of 34 and the delta for the call option is 33. So if I were to sell the strangle here, this would be a totally delta or directionally neutral strategy. And I would be looking to collect around $300 on selling one strangle here. And so if I come back to the charts here one more time, you can see 50 is right there on the charts, and 44 is down here, very close to the 200 period moving average, which is this yellow line right here. Now, I would definitely be okay selling the 44 strike put option, given that there seems to be a bit of support around this level, but the 50 strike call option might be a bit too close to where the stock is trading on the upside. And given that this market has done nothing but just go up every single month for the past year or so, I might want to push that call option a bit further out, maybe to the 52.5 strike. But I do also have to keep in mind that these options expire on June 18th, and Marvel does have earnings on June 7th. So like I said, I try to avoid those earnings announcements unless I'm specifically playing those announcements. So I definitely like what I'm seeing here with Marvel, and perhaps I will still trade it because June 7th is still very far out. But for the time being, I'm just going to put a pin on this one at the moment. So let's come back to the Market Watch tab here. And as I'm scanning down this list here, you can see there are a lot of earnings announcements coming up. So again, I have no issue playing these earnings events, but I want to wait until the day of those earnings before I actually sell options. But what about Stitch Fix here? It's a mid-price stock, about $44 per share. IV ranks a little over 32. Let's go check this one out. So SFIX, and definitely not bad. Like I said, IV rank 32% and IV percentile 56%. And generally what I look for at minimum is an IV rank above 20 or 25 and also an IV percentile above 50. So this stock here definitely fits that criteria. Let's go back to the Analyze tab here and take a look at when earnings are actually coming up for this company. Looks like June 7th again. So again, I'll put a pin on this stock, but I do want to check out the prices of the options first. And what I do prefer about Stitch Fix over Marvel is that the options are much more expensive on the stock, even though the prices of the actual stocks are about the same. Right? For the same 30 Delta Strangle on either side of the stock, I would actually collect about $500, not $300. So I do like Marvel, I do like Stitch Fix, but again, just because of earnings, I want to put a pin in those two for the time being and see if I can find anything else. And so now what I'm going to do here, just so that you don't have to sit there and watch me look at a bunch of different stocks, is I'm going to pause the recording and then come back once I've found any more stocks or ETFs that I want to trade. Okay, so I'm back. I took a look at this watch list here. Also took a look at my scanner as well to see if I could find any new stocks. And unfortunately right now, pretty much every stock with high implied volatility has earnings right around the corner, which is definitely not a bad thing. A lot of these earnings are coming up next week. So that just means for a lot of these stocks, I'm going to have to wait until next week. But I still definitely want to get at least one trade on today. And so I'm either going to sell a put option on either Marvel or Stitch Fix. I know earlier I was looking at strangles on these two stocks, but because earnings are coming up within the June expiration cycle, then I would rather have a more directional trade on than a neutral trade. Right? For example, if I were to sell the 50 strike call option and the 44 strike put option, and have a very tight strangle on, then if I'm still in this position by the earnings announcement on June 7th, well now if the stock moves in a large amount in either direction, I have risk on in both directions. Now that being said, when I do specifically play an earnings announcement, I most of the time use a strangle. I sell both a call and a put beyond the expected move of that stock and try to take advantage of the actual move of that stock being less than what's expected and also the implied volatility contracting thereafter. But the reason why I'm okay with a strangle when I specifically play an earnings announcement is because I make that trade literally minutes before those earnings figures come out. And so because of that, I can pick my strikes very carefully. Whereas unlike now, if I sold a strangle today, then come June 7th, this stock might be in a very, very different place. It might already be through my call strike. And then once those figures come out, then the stock could move even more, either to the upside or whipsaw and go to the downside and blow through my put. So again, in summary here, because earnings are coming up within the June expiration cycle, and because I'm making the trade today over a month out, I would rather have on a more directional play so that I don't have risk on both sides of the stock when those figures come out, if I'm still in the position at that time. So that's why either for Marvel here or for Stitch Fix, I'm considering selling a put option on either one of these stocks. I'm not going to do both because they both have earnings on the same day. So it's going to be one or the other. And I'm definitely leaning towards Stitch Fix because the premium, the implied volatility, is higher than for Marvel. Right? The actual implied volatility value for Stitch Fix is 78%. But for Marvel, it's only 52%. So even though the IV rank and IV percentile for Marvel is better than for Stitch Fix, because Stitch Fix at least meets my minimum criteria for IV rank and IV percentile, and also the actual implied volatility for Stitch Fix is higher than for Marvel, that's why the premiums or the prices for the options on Stitch Fix are much greater. So if I go into the trade tab here and take a look at the June expiration cycle, if I were to sell the 40 strike put option with a 33 delta, I would collect over $330 for this one contract. Whereas for Marvel, let's come back here. Let's look at the 34 strike put option for Marvel, basically the same delta. This option is trading for only about $170, basically half. And with my new approach to options trading, which you'll see play out over more and more of these videos, the more premium I can collect when putting on the trade, the better. So I am at minimum looking to collect at least $300 on any new position that I put on. Now, of course, I could sell two of these put option contracts, right? Two put options for $170 a piece will give me a total credit of $340, but now I've doubled the notional value on my position. Now I would have two put options tied to a total of 200 shares of Marvel, whereas for Stitch Fix, I could sell just one put option and still collect over $300, and the notional value of that position would be half, because selling only one put option on Stitch Fix is only tied to 100 shares, not 200. And the notional value of my positions is something I'm really going to have to take into consideration for this new approach, because I could potentially have to short shares of Marvel or Stitch Fix to hedge my put options if the stock keeps going lower. And it's going to require a lot less capital to short only 100 shares than short 200 shares. So that's why I'm leaning in favor of Stitch Fix here. I'm going to sell put option on this stock. And so let me zoom in a bit here. I'm considering the 40 strike put option, and given that Stitch Fix is currently in a downtrend, it may very well hit 40 or go lower, but I'm hoping that if it does continue to go lower, perhaps it might find support at this level right here at $42 per share, which it already did one time right there, or it might close this gap at around $37 or $36 per share and then rebound higher. Although to be honest, I really do not care if Stitch Fix blows through my put strike and goes down to $20 per share, because the moment that Stitch Fix breaches my put strike by a few pennies, I'm going to short the stock and turn my naked put option into a covered put option. And then if the stock rebounds and goes back above my put strike, I'll simply buy the shares back, because at that point, I would no longer need that protection. I would not need that hedge. And again, you'll see exactly how this all works over time as I put out more and more of these videos, and you actually see me apply my trading mechanics in a variety of different situations. So let's come back to the trade tab here, and we'll take a look one more time at the 40 strike put option. So it has a 33 delta. It's trading for about $350, and it has a less than 50% chance of expiring in the money. So I'm definitely okay with all that. So now let's go ahead and set up this order here. So I'm going to sell one contract, 40 strike put option, June expiration. And given that the bid and ask spread is about 15 cents wide, I'm going to set my limit price somewhere in between that. So I'll try 350 just to see if I can get filled, although I doubt it. And now I'll go to confirm and send and take a look at the buying power effect for selling this option. So as of right now, I'm going to have to lock up about $1,400 for selling this one put option. That's fine with me, right? Generally speaking, I like to keep my risk per trade under 5% of my total capital. So since my total capital in this account is $50,000, $1,400 of that is under 3%. So everything looks good here. And now I'll go to send. And so as I expected, this order did not get filled immediately. My price is a bit too high. So let me cancel and replace this order because I do want to get it filled in this video here. Let me come down a little bit. I'll go to 345, not a big deal. Confirm and send the order. There we go. So now I'm officially in this naked put option on Stitch Fix with a 40 strike. And as of right now, at least, my total credit on this position is $345. And so now the next step here is to create a GTC closing order that will automatically take my profits at a certain price point. So now I'll just click on the asking price for this put option. That sets up a buying order. And I typically take my profits at 50% of the maximum. So if I sold this put option for $345, that's the max profit. 50% of that is about 172, call it 170. So that is going to be the limit price that I will set here, $1.70, to buy back this put option for. And I'll make this a GTC order. And then once again, confirm and send that order, boom. So now if Stitch Fix has a nice rally and or implied volatility contracts, then at some point, the price of this put option is going to drop from 345 down to 170. And at that point, my closing order will get filled and I will automatically get taken out of the trade for profits without me having to do anything or having to watch my charts or my platform throughout the day. Now, alongside this also, I'm going to set up my hedging orders as well, so that if Stitch Fix does continue to fall, then I want a hedge to automatically get put into place and also get taken off automatically as well. And so as I mentioned earlier, the way you turn a naked put option into a covered put option is you short sell the stock. And specifically, I'm going to create a rather complex order that will short sell 100 shares of Stitch Fix at a price of around $40 per share, a little bit less. And if that happens, then that order is going to automatically trigger another order, which is going to buy those shares back if Stitch Fix then rebounds back above 40. And then that order, once again, will trigger another order, which will short sell the stock once more if Stitch Fix drops again below 40, and so on and so forth. It's an automated way of shorting and buying the shares so that I, as the trader, do not have to just sit here and watch these Stitch Fix charts and wait until Stitch Fix falls below 40 and then manually send the order and then wait again to see if Stitch Fix rallies above 40 and then send another order manually. I want this to be all automated as much as possible. So finally in this video here, let me set this order up first and then I'll show you how it works. Okay, so here you go. Here's the order that will do all this automation for me. And like I said, I do know this can look rather complex, but it's actually rather simple once you understand it. So each one of these rows here in red and green is a totally separate order. These are stop loss orders. And this whole thing here is packaged up as a first trigger sequential order type. So basically you can think of it as I'm sending one big order that consists of many smaller orders inside of it. And when you use the first trigger sequential type, that means only one of these smaller orders is going to get executed at a time, one after another. So for example, looking at this first one here, this is an order to short sell 100 shares of Stitch Fix, and it's a stop loss order that will take effect once Stitch Fix hits a price of $39.80. So it breaches my put strike just by a little bit. And if that happens, then this order will go through and I will short sell 100 shares of Stitch Fix at a price somewhere in between $39.80 and $38. Now ideally, the moment this order gets triggered, the moment Stitch Fix hits a price of $39.80, this order here should get filled rather quickly and hopefully at a price very close to $39.80. Maybe I get filled at $39.78 per share. This 38 you see here is simply my lower bound. And once this order gets filled and goes through, and now I'm short 100 shares of Stitch Fix, now the second order will become active. And this order is a buying order to purchase 100 shares of Stitch Fix. So it essentially closes out the short position that got put on previously. And this order will get executed. It will get filled if Stitch Fix rebounds and goes above $40.20. And then once this order gets filled, then the next order becomes active. And once again, this is another order to short sell 100 shares of Stitch Fix at $39.80. And so like I said, this is just my way of automating the buying and selling of shares so that I don't have to do it manually. And right now I have basically 4 cycles of this set up. And by cycles, I mean one full cycle being I short 100 shares and then I buy back 100 shares. That's one cycle. So I have 4 of them already set up. So eventually, if I do blow through all these orders, I will have to set up more of them. But at least for a time, this will be totally automated. And so now I did just try to confirm and send this order, but there was a problem. Apparently there's an issue with these orders being GTC orders. So I had to recreate this and change them as just day orders for the time being. I'll have to look into this and see what's going on. But generally speaking, I would prefer this to be a GTC order so that this whole thing is just sitting out there every single day and waiting for Stitch Fix to move against me. But as of right now, TD Ameritrade is only allowing these to be day orders. So that means I simply might have to recreate this every single morning for each trading day. Not a big deal. It takes about 45 seconds to make this anyway. So we'll go to confirm and send once again. Buying power effect is 1500. That's fine. Send that order. There we go. Now if I come back to the monitor tab, now at least for today, all those orders are just sitting there waiting to provide or take off my protection. And so the last thing I want to mention here in this video, I know it's getting rather long already, but I do want to briefly mention the risk that comes with this kind of approach to options trading, right? Because when you think about it, theoretically at least, if I'm able to short shares of stock right at my strike price and then buy them back right at my strike price, then theoretically, I have no risk on the trade. I sell my put option for $345, and then I just short my shares at the strike price if Stitch Fix keeps going lower, and then I just buy them back at the strike price if Stitch Fix rebounds, repeat that process. It seems like I have no risk on the trade. But in actuality, the risk comes with the slippage of having to continually buy and sell shares of stock, right? Because again, if my orders here are set to short 100 shares at a price of $39.80 and then buy them back at a price of $40.20, that's a difference of 40 cents per share that I could lose when that happens. Times 100 shares, that's $40. So every time I complete one cycle of this, shorting 100 shares, then buying them back if Stitch Fix rebounds, I'm going to lose $40. Now for the time being, if that happens a couple times, it's no big deal because once again, I'm only targeting 50% of the maximum total profit. I sold this put option for $345 and I'm only trying to make about 170 on it. So that means already built in, I have about $170 I could lose from those slippage costs, from that buying and selling of shares if Stitch Fix does continue to go lower and just kind of bounce around my strike price for a while. And so like I said, if that happens a few times, no big deal. But if it happens a lot and that slippage starts to really eat into my potential profits, then I will have to make adjustments to this position to take in more credit. And in doing so, offset those slippage costs. And that's something you will see at some point with these live trading videos. It might happen for Stitch Fix here, or it might not. But point is, even with this kind of approach, where it seems like initially, maybe theoretically, I have no risk or very little risk, there still is risk. And there will always be risk in anything you do in financial markets. No matter what you do, what strategy you are using, you are always taking on some level of risk. So with that being said, that wraps it up for this video here. I know it was rather long and potentially a bit confusing if you've never seen this stuff before, but I promise you, if you keep watching my videos and you keep watching these live trading videos going forward, over time this stuff will become simple to understand. When you get down to it, I'm simply selling options and then using shares of the stock to protect or hedge myself when the position moves against me. That's really it. So thanks again for watching, and if you enjoyed this video, please hit the like button and subscribe to my channel. And also, if you want to take a deep dive into options trading and stock market investing concepts, then check out my courses on SKILLSHARE as well. And I provided links to some of the introductory courses of mine in the description of this video below. So thanks again for watching, and I'll see you next time.